You might think the world's richer than ever, and you'd be right, but here's the weird part. Global growth is actually slowing down. It's like watching a marathon runner who just set a personal record, then starts gasping at mile 10. The economy's still moving, just not like it used to. And that slowdown is quietly reshaping everything. Jobs, trade, even which countries rise or fall next. So what's going on? How can global GDP hit new highs while everyone keeps saying the world's cooling off? In this episode, we'll break down why the global growth engine is losing steam, what's causing it, who's being hit hardest, and which countries are still quietly booming while others stall. Because behind the charts and numbers, the global economy is starting to look less like a race and more like a traffic jam. So here's the thing, if you only looked at the headlines, you'd think the world economy is doing fine. Inflation's cooling, unemployment's mostly stable, markets are buzzing again. What's the problem, right? Well, the problem is speed. According to the IMF's World Economic Outlook 2025, global growth is sitting at around 3.2%, basically stuck in second gear. 20 years ago, that number was 3.7%. It doesn't sound like much, but that small gap adds up to trillions in lost output over time. Think of the global economy like a jet. It's still flying, just using more fuel to stay in the air. Every major region, from the US to Europe to China, is showing signs of fatigue. So what's slowing the engines? Let's unpack this. First gear, trade isn't doing its job anymore. For decades, global trade was the turbocharger. Countries specialized, shipped, imported, built global supply chains. Everyone got richer together. But after COVID, the global everything model started cracking. Nations realized that relying on one factory in China or one chip plant in Taiwan was risky. So now everyone's de-risking. Supply chains are getting shorter, less efficient, and a lot more expensive.
In 2025, trade is growing slower than the economy itself, barely 1.7%. That's unheard of. And when trade slows, so does investment, innovation, and productivity. The world basically took the globalization engine, popped it open, and started pulling out parts. Second gear, debt hangover. During the pandemic, governments threw money at the problem. Stimulus checks, rescue packages, business bailouts. It worked for a while. But now those bills are coming due. Interest rates are higher, debt payments are eating national budgets, and there's no cash left for new projects. So even though inflation's cooling, governments can't spend the way they used to. That means fewer infrastructure projects, less job creation, and slower growth. It's like running out of adrenaline after a crisis. The body's still standing, but it's tired. Third gear, demographics. Every major rich country is aging. Japan's median age is already 50. Europe's isn't far behind. Even China's working age population is shrinking. When people retire, they spend less and produce less. Fewer workers mean less output and more pressure on the younger generation to pay for it all. This is why many advanced economies feel stuck in a loop. Strong companies, but slow consumers. Big tech profits, but small pay rises. It's not that the world ran out of ideas, it ran out of people to do them. Now add the fourth gear, uncertainty. From trade wars to climate disasters to AI regulations, governments and businesses are basically guessing what's safe to invest in. And when nobody knows the rules, money stays on the sidelines.
This is why we're seeing so much hesitation. Firms aren't building new plants, they're buying back their own shares. Consumers aren't upgrading cars, they're keeping old ones longer. The world has entered what economists call the precautionary pause. Everything looks stable, but it's really just everyone holding their breath. And here's where it gets interesting. While the big players slow down, a few countries are actually accelerating, places you might not expect. Let's look at who's booming and why. So while the big guys are catching their breath, a few economies are sprinting ahead like it's the start of a brand new race. And no surprise, Asia is where most of the action is. India first. The country's basically the world's growth engine right now. The IMF pegs India's 2025 growth at 6.6%, which is nearly double the global average. That's not luck, that's scale plus momentum. You've got a massive young workforce, exploding digital adoption, and hundreds of millions of people still entering the formal economy. add in foreign manufacturers shifting away from China, and you've got a perfect setup for a decade-long boom. But let's be clear, this isn't an overnight miracle. India's success is happening because the rest of the world slowed down. Multinationals needed a China plus one plan, and India became the plus one. Next stop, Southeast Asia. Vietnam, Indonesia, and the Philippines are all riding the same manufacturing wave. When trade between the US and China turned political, supply chains quietly rerouted through these countries.
Vietnam now assembles more electronics for the US than ever before. Indonesia is hoarding nickel, the critical mineral for EV batteries. And the Philippines is exporting labor and services faster than pre-pandemic levels. They're not just benefiting from cheaper labor, they're plugging into global demand that's shifting south. Now, let's move west. The Middle East is quietly having a moment. Saudi Arabia and the UAE are reinventing themselves faster than anyone predicted. With oil money as a cushion, they're diversifying into tourism, logistics, and green energy. Riyadh's mega projects, Neom, Qiddiya, aren't just PR, they're attempts to build post-oil economies before demand fades. And despite oil prices staying volatile, energy exporters are still sitting on huge fiscal surpluses. Here's the irony. When growth slows globally, energy demand usually falls, but these countries anticipated that and started pouring money into non-oil sectors. So when everyone else hesitates, the Gulf keeps building. Africa, the sleeper story. The continent's GDP is set to grow around 4% this year, with countries like Kenya, Ethiopia, and Rwanda pulling heavy weight. Why? 2 words: young population. Africa will add almost 1 billion people by 2050, and half of them will be under 25. That's a goldmine for cheap labor, entrepreneurship, and local consumption, if governments can build infrastructure fast enough. Foreign investors have noticed. China's investments are slowing, but the EU, US, and India are quietly stepping in. New ports, fiber optic cables, fintech hubs, it's all happening, even if it's not trending on CNBC. Meanwhile, Latin America is stuck in neutral, but not for lack of effort.
Brazil and Mexico are benefiting from nearshoring. When US firms try to bring manufacturing closer to home, Mexico becomes the natural alternative. Automakers, electronics, and even clothing brands are quietly shifting plants south of the border. Mexico's exports to the US just hit record highs. And Brazil? It's turning into an energy transition powerhouse. Biofuels, green hydrogen, hydropower. The IMF expects the region to grow around 2 to 2.5%. Not explosive, but solid given inflation battles and political turbulence. Now, back to the rich world, the supposed anchors of stability. The US, Europe, Japan, all slowing, all cautious. The US economy is still the most resilient, around 2% growth, but it's fueled by consumer spending and federal debt, which both are unsustainable. Europe's story is even duller. Germany's industrial base is wobbling, France is juggling strikes and deficits, and Italy's debt is pushing new limits. And Japan? A rare bright spot among developed nations. After decades of stagnation, it's finally seeing modest inflation, the good kind, and a bit of wage growth. But with its aging population, it's like a 70-year-old finally joining the gym. Good effort, but the results take time. Here's the kicker. This divergence, slow rich world, fast emerging world, is the new normal. Economists call it multi-speed growth. But it's also a kind of quiet reshuffling of global influence. When emerging markets grow faster, they gain negotiating power, trade leverage, and cultural weight. Think about it. In 2010, the G7 produced about 46% of global GDP. By 2025, it's closer to 40%. The rest of the world is catching up. But here's where things twist again. Those same booming economies, India, Vietnam, Saudi Arabia, depend heavily on exports to the slow ones. If the US and Europe hit a recession, the ripple still hits them. So it's not that the world has split in two, it's just become a more complex relay race. One runner slows down, another speeds up, and the baton never really stops moving. And as the power shifts east and south, a new question appears. Can these fast-growing nations keep the engine running, or will they slow too once they hit middle-income barriers? That's where we'll head next, the hidden traps that could decide whether today's winners stay on top or stall out just like everyone else. All right, we've seen who's booming, but let's be honest, even the winners aren't safe. Because beneath all that new growth, a quieter problem is building, one that could drag everyone down again. Here's the paradox. The very things driving the new boom, cheap labor, global demand, endless investment, are also the things that eventually burn out. Economists call it the middle income trap, but you could also call it the treadmill. You run faster and faster just to stay in place. Take China. It was the poster child for unstoppable growth. For 30 years, the model worked. Factories, exports, infrastructure. But now, demographics, debt, and deflation are slowing it. Property bubbles burst, young people can't find jobs, and local governments are buried in IOUs.
That's the warning sign for every country rising today. India, Vietnam, Indonesia. Growth built on cheap production eventually needs brains, not hands. So how do they avoid that wall? By upgrading. Education, innovation, automation, basically turning from workshop to laboratory. India's tech scene is a good start. Vietnam's investing heavily in semiconductors. Indonesia is trying to move from exporting minerals to building EV batteries. But this shift isn't cheap or fast. It needs policy stability, trust, and capital, 3 things developing nations usually run short on. And that brings us to the second big risk, fragmentation. For decades, globalization meant efficiency, the best supplier, the cheapest price, the smoothest logistics. Now it means risk. Everyone's building walls. The US wants domestic chips, Europe wants energy independence, China wants self-reliance. So the world economy is slowly dividing into economic clubs, one built around the US and allies, another around China, and a few flexible players in between. It's not a full-blown trade war, it's more like 2 Wi-Fi networks that don't talk to each other. And the result? Higher prices, duplicated factories, slower innovation. That's great if you work in geopolitics, terrible if you care about growth. The third break on global growth is climate transition. Here's the cruel twist. The planet needs to cool down, but the economy heats up slower as a result. Moving to green energy means retiring old industries, rewriting supply chains, and building infrastructure that takes decades to pay off. Short-term drag, long-term survival. Europe's learning that the hard way. High energy costs after the Ukraine war forced factories to scale back. Meanwhile, developing nations say, hey, you had your carbon party for 150 years. Now you want us to pay for cleanup? This tension between growth and green is now one of the biggest dividing lines in global economics.
But here's where it gets interesting. Maybe slower growth isn't a glitch. Maybe it's evolution. Think about it. The old system rewarded speed. Produce more, consume more, repeat. The new one might reward resilience. Produce smarter, waste less, adapt faster. In other words, growth might be trading volume for intelligence. Countries like South Korea, Singapore, and the Nordics showed this pattern already. Smaller growth percentages, but higher quality of life, stable inequality, and steady innovation. If the future looks like that, then slow growth isn't failure, it's maturity. Still, for most people, slower growth feels bad. Wages crawl, rents rise, groceries cost more. That's why public frustration is building everywhere. Strikes in France, protests in the UK, political tension in the US, populism in Europe. When growth slows, politics gets louder, because suddenly the pie isn't growing fast enough for everyone to get a bigger slice. So where does that leave us? In a kind of adolescence. The world has outgrown its old model, but hasn't quite found its new one. The West is learning how to live with slower productivity. The East is learning how to grow without cheap exports. And the South is trying to catch up without wrecking the planet. That's not stagnation, that's a system in transition. Which brings us back to our question. Why is global growth slowing, and which countries are booming? Because the baton is being passed from debt-heavy nations to youthful ones, from mass manufacturing to digital innovation, from reckless expansion to cautious sustainability. Growth hasn't disappeared, it's just moved addresses. And maybe that's the bigger story. For decades, we thought more was the goal. Now we're learning that better might be harder, but worth it. So next time you hear global growth is slowing, don't picture a crash. Picture a world learning to drive smarter, not faster. Because the real question isn't how much we grow, it's what we grow into next.